Aashish Somaiyaa, who is joining in, MD and CEO Motilal Oswal, AMC, to talk about the texture of the market and top themes that he's betting on. Good morning, Aashish, and good to have you on board. Just today, we were reading this morning about similarities between the US markets as well as ours, even though, of course, there's this much bigger in size. And one of the factors is, the common factors is that it's been only a select bunch of stocks on the index that has driven the market higher. Things seem to be changing now with the broader markets playing catch up. What is your sense as to how the rest of the year could potentially shape up?
Yeah, 2020 has of course started on a good note. In the last 3 to 6 months, I think right from mid 2019, we have been kind of communicating that at some point in time, the market movement has to broaden out. And my sense is since October, November onwards, we could see some early signs of money moving into other parts of the market. So we are quite happy to see this kind of development. Because as most people are aware, as a house, especially on our PMS and AIF, the alternates, we are significantly invested into small and mid caps. And in any 5-year cycle, we have seen that eventually they do end up making money. And last 2 years has been difficult. So from that perspective, I think 2020 has started on a pretty good note. And my sense is that once this trend kind of picks up, because a lot of these large caps which have been expensive and which have done very well in the last 2 years, my sense is then they tend to become kind of a funding source for money to get reallocated and rebalanced, because all the moves are not backed by fresh flows at all points in time. So I think it's a good start, a good trend which has started, and I expect that to continue.
What's also been very noteworthy, Aashish, is the kind of global commodity recovery that we've seen. Of late, a lot of the metal stocks as well have had a terrific run, the likes of JSPL, Tata Steel, SAIL, Vedanta, etc. What is your outlook on the trajectory for some of these commodities at a time when we're constantly monitoring what's going on globally as well?
No, I think I'm sure it's quite a relief from both perspectives. I think one is the geopolitical perspective, and second obviously is also the fact that there is a trade deal which is being spoken about. So I'm sure it's come as a significant relief. And if the geopolitical situation remains as benign as it has turned out to be in the last few days, given that there were no escalations fortunately, and on the other hand, if there is progress which one can see on those trade deals, then I expect that to continue. We at our end, of course, our policies kind of prohibit us from investing into any commodity backed sectors. Be that as it may, my sense is that it will sustain from here on.
On the balancing act, Aashish, is it now prudent, or rather has the time come to actually shift out of large caps, make a higher allocation to small and mid cap funds, or would you say, still go for the balanced funds? What is it that you're recommending to your clients?
See, I think, like I said, we have been, I myself as well as my firm has been a votary of having good allocation to mid caps. Last 2 years, we haven't been looking that smart, but I think that's just part of the investing journey. I'll just step back and share some interesting data with you, in terms of where does this belief of investing in mid cap comes from. If you see, our chairman has been publishing these wealth creation studies for maybe now 23 years. And if you look at these wealth creation studies, there is always a section wherein we kind of do these, do some number crunching. And if you take any 5-year time frame, you define mid cap as per the SEBI definition of 101 to 250. We used to previously define it as 101 to 300. And what we've seen is that if you just dispassionately hold a bunch of, or the entire basket of 101 to 300, you hold it dispassionately for a 5-year time frame. What you will find is that at the end of any 5-year rolling time frame, you will find that anywhere between 40 to 60% of this universe of stocks, it either remains mid cap, or it turns into, or it converts or grows into large cap. And the median return tends to be a reasonably good double-digit number. Now, guys like us, obviously, we don't buy the whole basket. We apply certain filters and certain criteria, and we try to enhance our probability. So all the past data of the Indian market actually shows that if you're a discerning stock picker and you have some 5-year kind of time horizon for mid caps, there is a very good probability that you will end up owning, which gives you a good CAGR, or even possibly grows into becoming a large cap. The other thing important is that, while last 2 years market trends have been very, very divergent, the other fact which one cannot run away from is that in India, a lot of sector leaders are actually mid caps, and that's not because these are small companies by nature. It's just that the sectors may not have had their growth as of yet, and it's just that the sector is in a stage of evolution. So I think there's a very strong case for being in mid cap. We have always been a votary of mid cap, and sorry I gave you a long answer, but on your question, it is definitely time for people to review their allocations and stop this rear view mirror kind of thought process.
Makes sense. But where within mid-caps, Aashish, is the opportunity emerging? Because across categories, one has seen subdued returns over the last 1 to 2 years. And now suddenly you are seeing bits and starts, some of the gas stocks, some of the cement companies, paint companies, lots of other pockets actually, real estate, what have you, are beginning to now prop up. Where is it that you find opportunity?
So our portfolios are actually, and I'm not reacting to last 15 days really, but our portfolios have always been geared towards domestic pharma. They have been geared towards, like you mentioned, gas and those kind of the city gas distribution companies, the mid-cap cement companies, some of the NBFCs, mid-cap NBFCs, mid-cap private sector banks, auto ancillaries. Been through a tough cycle, but we've kind of held on. So, and of course there are a lot of mid-cap consumer durable, even some of the insurance companies in the mid-cap space, there are a couple of them. So even a lot of the asset management companies which are listed, capital market companies, are in mid-cap space. So while we stay away from a lot of the deep cyclicals or infra-backed or any of those sectors, but all the sectors that I mentioned, they do find pretty significant allocations in all our portfolios. And like I said, it's not last 15 days, this is how it has been for last 3 to 4 years. And of course 2018 and 19 it went through a bad patch, but I think all of this is seeing at least in our portfolios, we can see very sharp uptick in the last 1 month.
Aashish, there's lots of news now going about as to what we could potentially see in the budget. The Economic Times suggesting that the long-term capital gains, the government is seeking advice to do away with it because it's been criticized. We've seen market sentiment that has been depressed on the back of that. A, your views on what this tweak in LTCG could mean, and B, what else is it that you're expecting from the budget?
Yeah. See, I think that, a couple of years back when the LTCG came, so there are 2-3 things in the context one needs to really keep in mind. First is that the biggest seller of equities in the market is the government itself as a promoter. And from that perspective, I think that, when we want equity markets and there has to be respect for the sources or the funders of this capital. The people who are providing the capital and the people who are sourcing the capital, I think definitely their feedback and their ability to invest should be taken into account. So given that the government is the biggest seller of equities in the market, I don't think it really suited them to rock the boat in a manner whereby we become actually uncompetitive from a global landscape. And in the global landscape there are 2 or 3 things. One is the LTCG, which has been debated at various points in time. And the second, which our chairman and myself and our house has been representing pretty vociferously, is about dividend taxes. Because we are taxing income at so many sources. First the companies are paying tax, and then when the company passes the earnings to its rightful owners, again there is a distribution tax. And when the money finally, the income reaches the owner, again he has to pay tax. So I think this is not right from any perspective, and I think definitely this has to be looked into because equity capital is risk capital. It is by nature meant to be scarce, and people need to be compensated for those risks. And even if that sounds theoretical, if nothing, at least the global parity needs to be maintained, because India is definitely not America and India is definitely not China. We are in need of capital, so we have to do everything it takes to attract that capital. I mean, I know for a fact we deal with a lot of foreign institutions. I know for a fact that there was somebody who was supposed to invest with us, and for 18 months they put it on hold, and we've not heard from them. So it has definitely impacted how people view the Indian market, and it's high time that it is kind of reconsidered.
All right. Thank you for joining us this morning, Aashish, and sharing with us your views on the current state of things.